In this video, traders, we're going to look at and answer the question, what's better, a quicker, smaller profit or a larger profit that takes a longer amount of time? Stay tuned. Hey traders, warm welcome to you. All right, so this is my thought on this question. The question is this: which is better, to take a quick, smaller profit or to wait for a longer time to make a larger profit? Let me know your thoughts in the comment section below as we go through this video. I'm going to go through it. I'm going to talk about my opinion on it, what made me think about this, and maybe some things that we could take away for our own trading and give ourselves some additional rules for our setups. So I've got two examples for you. Let's say, and this is kind of actually based on a recent trade that I did. Let's say we're sitting here and we've got a short position on. Right, same scenario. We've got a short position on here. I won't put it twice, just put S. And our target is down here. Our target is down here. Regardless of what the whole premise and thesis of the trade is, that's the setup. All of a sudden, we're chugging along. We've been in it for a while. We've taken a little bit of heat and it's now come back, and whatever it may be, let's say we've taken it's come down here, it's done this, it's done that. Regardless of what happens now. And then all of a sudden we kind of see this and it shutters down pretty quickly to about there. And we say to ourselves, all right, what's happened now? So that's that. This one, however, does nothing and maybe slowly goes down, but you don't know whether it's going to hit. Okay, so you've got two scenarios here. So really the question I'm posing to you guys is, if you're short here, and we're talking from a day trading perspective here, could be swing trading as well, I guess, but this is from a day trade example. So we're short from this level here. Market suddenly shudders to the downside. Now, assuming we give it enough time to ensure the fact that negative news hasn't hit the market, because of course, if negative news has suddenly hit the market and you're short, the last thing you want to be doing is covering just out of a panic. You want to be riding that thing, you want to be cancelling your limit, in fact, and trying to milk that thing for all it's worth. If it's going to crumble 200 ticks, you don't want to be grabbing 25 tick profit on it. So, and yes, okay, sometimes you might get it wrong, but the point is you can trade that in an exclusive manner. So once you've decided, hey, you've seen it shutter down, there's a bit of volume there, maybe it kind of stalls a bit, you don't see a second leg, maybe it starts to creep back up. It doesn't look like it's just, you know, when extreme news hits the market, it does that, then it goes another leg really quickly because it's people just hammering market orders. So it's not that. You've made the decision, rightly or wrongly, but you've made the decision that it's not some news that's going to hit this thing and crumble it through the floor. The point is now, do you take the profit, bank it, let's say it is half, 50% of what you've expected, or do you sit with it and push on? Now, the pros and cons of both are this. Now, I know the textbooks, and I probably mentioned this before, are going to say to you, hey, well, you know what, your target is your target. Regardless of what's happened, you should hold for your target. And there is definitely an element of truth in that. If you start meddling with your system too much, then you're going to negate things. And we talked about this before in videos. If you start meddling with systems, you start messing around, you're just going to end up ruining any expectancy you've got. You're not going to have any learning to learn from. However, assume you've been in this trade for a while, which you have. You've seen some kind of move against you, hasn't stopped you out, it's come down. You're kind of looking at it thinking, you know what, it is what it is. It's a trade, it's still, it hasn't stopped me out, it hasn't hit my target yet. But perhaps you're doubting it a little bit. Perhaps you're thinking, I don't know whether to stay in this or not. And that's an element that we often don't talk about in terms of the trade plan, when you're going to scratch the trade, when you're going to ditch it if you don't like it. So obviously if you're about to ditch it and this happens, then you just take it and it's free money. But what happens if you still like the trade and then you suddenly get this? Do you take it, or you do look for the longer term play? Now, the thing is, what you've got to do is you've got to objectively look at the trade and say, is the trade still as good as a trade as it was when I first put it on? Now you've got to make the assumption that if you've sat through this and through some heat, unless it's this very specific setup that allows for this, then the chances of it being a great trade as it was at the beginning probably have diminished, especially if you're on a day trading time frame. And so if you get that quick profit, there's something to be said for taking advantage of that and saying, you know what, at least let me cover half the position. At least let me take advantage of this, take some off the table and see if I get a further move on it. I've been incorrect with the market conditions because I've taken this short and it's stagnated for the last 10, 15 minutes. So I read that incorrectly. I may well be reading direction incorrectly. And so this may well be your get out of jail free card. Like, hey, well, I'll take that quick 25, 28 ticks, whatever, stick it in my pocket and see what happens with the rest. But then the flip side, then you're saying, well, you know, I don't want to meddle with it. Yes, it's stagnated. I've allowed for that stagnation. I should be holding it until the very end and the very limit. Now, I'm going to say to you guys, I think under the right conditions, this is the correct thing to do. And those conditions are this. Number one, the trade has reduced its expectancy for you as you've been sitting here, i.e. maybe it's been drifting around doing nothing. Maybe the price pattern is now not as juicy as it was. In other words, let's just say for argument's sake, the easy one that I always use, you're buying this pullback, okay, you've gone long, and let's say it's kind of now sat here and it's done this, right? It's not stopped you out yet. It's not broken out. It's just done this. Is that as strong as just that initial pullback there? No, but it's not. It's starting to reduce. It's not quite at the point where you're going to get rid of it, which may be here time-wise. It's not stopped you out yet. It's not hit your target. It's just sat there. But the expectancy of the trade now has diminished and diminished and diminished. So if you're in that scenario, then I think it's quite right to say, right, well, I'm going to bring my target in a little bit. I'm going to, if I see an opportunity, I'm going to take it, which is where this comes in. So as the trade expectancy lowers, you're like, well, the setup's not as good now. It was great. It still stopped me out. It's still not hit my limit. It's not hit my price time target or price time stop, or trade duration stop is probably a better phrase for that. So I'm still okay. I'm still in it, but you know, I'm at the point of scratching it. I'm at the point of not wanting to take it. If you're at that point and you get this gift, then I think you should say, well, you know what, I'm going to take that as luck, because it could easily be a spike in the other direction, right? It could easily be a spike up that stops you out. So you may as well leverage on that on both ways as well. So if you get it in your direction, you take the limit. Now, there is something to be said, of course, for how do you quantify that? Well, that's down to you and your trade ideas and your trade strategy. You know, for me, if I'm trading something like that, for example, or in this case, which was a double top at a key level starts to roll over, I want to see, the ideal trade is that it starts to roll over quickly for me. A stagnation near the highs that kind of takes out a double top again, does a bit low, does that, really is starting to reduce the expectancy quite dramatically for me. And so seeing a kind of lucky profit, and it is a bit of luck at the end of the day, seems like it's sensible to take that as opposed to being, although I hate using the word greedy, because we have to kind of look for those extended moves. Otherwise, if we don't look for extended moves, then the whole expectancy of the setup doesn't work. But if we're in this scenario, let's say this, right? Let's say we do get a move straight down, and we get that, but it happens immediately. Would you take the profit then? No, you wouldn't, because the trade is doing exactly what you want. And there's that fine line. A lot of people are banking that profit as soon as it hits that, and then they're saying, well, you know, it's fine to do it when it's later on, but there's a distinct difference. If the trade is doing exactly what you want, then you need to, you know, milk it for all you can and hit that target. If the trade isn't doing what you want and it starts to reduce what you're expecting it to be, in this case, you know, there isn't that sharp reversal, it's stagnating, it looks like it could be 50-50, but you're still in the deal. You've got to do something with the deal. You can either scratch it or you can adjust things. Then you get something that moves in your favor. Then that becomes slightly different. And I know there's a little bit of subjectivity here, guys, and I know there's a little bit of like, well, you know, do you hold it, do you don't hold it? And you know, that's trading. Unfortunately, it's not just black and white. We try to make it as much black and white as possible with kind of rules and strategies and setups and stuff. But there's certain times like this, you're in a trade, it's not quite hit your stop, it's not quite hit your limit, it's not quite doing what you want, the market moves in your favor. Do you grab it? Probably you should. Should you hold it? Nah, I don't think you should, because generally speaking, the trade's reduced its expectancy. However, if that happens earlier, then don't snatch it. Don't snatch at it. Let it run its course. Hopefully you see the distinct difference there, guys. And let me know your thoughts in the comment section below. I'm not saying I'm right. I think that works for me. I don't know if it works for you. Obviously, if you're not at the screen, you're setting and forgetting, you're not going to be able to take advantage of that, and it doesn't apply to you. But if it happens to be at the screen and you put the trade on and you're watching for your exit, whatever it may be, then this may well apply. And the same with the swing trading as well. Perhaps you've got the trade, it's stagnated for weeks. You kind of don't really want it anymore, but you're in it. You don't want to stop yourself out. You don't really, can't bring yourself to scratch it out either. Sorry, hasn't hit your stop, hasn't hit your limit. You don't want to scratch it either. Then you get a little windfall. Do you then go, oh, I'll just take that and move on to the next trade that's got a better setup? Let me know your thoughts in the comment section below, guys. And whatever you're doing, take care, keep your risk managed. Bye-bye.